Welcome to the last class of the semester. In today's video, what we're going to be reviewing is how information from the financial statements can be used to understand what a company has been doing, what it has been doing well, what it has been doing poorly, and by using the dupont relationship, which uses three different groups, three different types of ratios to deconstruct the total performance of the company through its return on equity into its performance in profitability, its performance in efficiency, and the amount of financial leverage that it's using. So let's go ahead and take a look at a company where we have the dupont information about it and also the relevant industry information. So in our company, we're going to be looking at, first of all, let's remember what the different ratios, the main ratios that we're going to be using are. So first we have the return on assets, sometimes also referred to as return on investment. So what this does is it tells us about, let me change this into a pointer. It tells us what have your assets been generating in terms of total profit. So net earnings or net income or net profit divided by total assets. So this measures the performance of the company at using its assets to generate net income. Return on equity looks at it from a slightly different point of view. Again, it uses net earnings, net income. So how much profit have we been generating? But rather than the total investments in total assets, it looks at it from the point of view of shareholders or equity holders. They haven't put up 100% of the funding to buy all of the assets. They have only been financing the equity portion of that. So out of their total investments, equity, how much net income has that been generating is what ROE or return on equity tries to measure. There's also been some attempts to calculate a more cash-based profitability measures as well, but we're mainly going to be focusing on the first two of these. So again, the dupont analysis basically takes ROE and ROA and deconstructs these into their components. So the first one, ROA, return on assets, net income over total assets, can be calculated as the multiplication of net profit margin and total asset turnover. So the return on assets is made up of how successful are we at generating profits out of our sales as measured by NPM, net profit margin, multiplied by our efficiency at generating sales out of our asset investments. So multiplying these two gives us our ROA. And then taking the return on assets and multiplying that by the amount of financial leverage used gives us our ROE. And here, sometimes we refer to it as financial leverage. Sometimes you might hear it being referred to as the equity multiplier. What we have here is total assets divided by equity. So the financial leverage or the equity multiplier measures using your equity investments and thanks to the use of financial leverage, debt, how much of a bigger company have we been able to obtain? So if we used zero debt, and let's say we had $1 million to invest as equity, then the maximum size of the company at the beginning would be 1 million of assets. So your equity multiplier for a company with zero debt using no financial leverage would be equal to 1. 1 million in assets divided by 1 million in equity. The more Financial leverage, the more debt is being used, causes financial leverage to go up. So, if, for example, the company was using 50% financial leverage, meaning that in addition to $1 million of equity, if it also borrowed $1 million of debt, in that case, we would end up with a company whose total assets from the start could be $2 million. So the equity multiplier, 2 million over 1 million equity, would become 2 in that case. So when if we expand ROE to its three components, we have ROE being equal to NPM. How successful are we at generating profit out of our sales, multiplied by total asset turnover? How are we using our assets to generate sales? How efficiently are we doing this? And financial leverage, also called equity multiplier, for your investment in equity. How much bigger of a company do you have thanks to the use of debt on top of this? So if we include the formulas, NPM is equal to net income over sales. Total asset turnover is sales over total assets, and financial leverage is total assets over equity. And when we multiply these three, if you look carefully, you will notice that the sales will cancel each other, total assets will cancel each other, and what you end up with is net income divided by total equity, which is the formula for return on equity. So that's basically what we're doing. In addition to this, something which I have attempted to add on to the dupont analysis is, could we take this net profit margin and break it down into its subcomponents? Unfortunately, it's not as nice and clean as multiplying three ratios. But what I use in this case is the fact that the net profit margin can actually be written out as 1 minus the cost of goods sold percentage, minus operating expense percentage, minus interest expense percentage, minus taxes. So basically, you start out with 100%, and by deducting all of the different expenses from this number, we can calculate net profit margin. So what this does is it allows us to deconstruct the total profitability of the company into its success at controlling different types of expenses. Because two companies with identical net profit margins don't necessarily have to be the same in all aspects. Maybe one company is good at controlling cost of goods sold, while the other is good at controlling operating expenses. And because these cancel each other, they might end up with the same net profit margin. But this doesn't mean that what they're doing is the same. It gets you to the same point, but I'd really I would want to understand how are they performing in these different aspects of profitability. So the kind of extended dupont relationship becomes ROE is equal to this first term, which is the net profit margin, multiplied by total asset turnover and financial leverage. So now let's try to see how this can be applied to some actual financial data from a company. So here I provide you with an example company, which is in an industry. And here we have the numbers for 2004 of the industry and of the company itself. And I'm basically giving you, well, we actually could do this analysis by just using the total asset turnover, the debt ratio, which we're going to use to determine the equity multiplier. I will show you how we can calculate that. And we actually don't need the gross profit and operating profit margins. Just the net profit margin would be sufficient. But as I stated before, I'm interested not in just what is the difference in net profit margin between the companies. And we can see here that there's a pretty big difference between the industry and company net profit margin. The company is at a distinct disadvantage. There's about 3 percentage point difference between the industry and the company. The company is at a pretty significant disadvantage when it comes to profitability. But does this carry forward into the return on assets and return on equity? So, what I would like you to do right now is stop the video, keep this open, and look at these numbers and try to use that to interpret what the company is doing well, what it's doing poorly, what are its advantages, disadvantages, and would you be able to come up with a meaningful interpretation of this financial data just with this information? And you know what? I'm going to make it just a little bit easier for you using this information, actually the total asset turnover, the debt ratio, and the net profit margin. We can actually also calculate the ROA, return on assets, and ROE, return on equity. Let me gift that information to you as well. So to calculate ROA, what was the formula, the breakdown? Net profit margin multiplied by total asset turnover gives us the return on assets for this company. So net profit margin for the company, 9.93, just slightly less than 10%, multiplied by total asset turnover will give you the ROA for the company, and 13% multiplied by 1.04 will give you the return on assets for the industry. If you also want the number for return on equity, we need to multiply the ROA numbers that we've calculated by the equity multiplier. Equity multiplier formula was total assets over total equity. And that number can be obtained from the debt ratio for the industry and the company. So 50% debt ratio means that 50% of the financing has been coming from creditors, from debt. If you also keep in mind that total assets is always equal to total liabilities plus equity, then if 50% debt is used, then you also should know that the remaining 50% has to come from equity. So the equity multiplier, total assets divided by total assets divided by equity would be 100 divided by 50 equity in the industry. And for the company, which has 65% debt, means that 35%, 100 minus 65, 35% of the financing has been coming from equity. So the equity multiplier for our company in 2024 would be 100 divided by 0.35. So with this information, you can easily do this calculation as well. And what we find is that the return on assets of the industry is 13.52%. And for the company in 2024, it is higher. It is 18.47. So the company has an advantage in ROA, and in ROE, the story becomes even more interesting. The industry has 27.04% return on equity, while the company has 52.78. So now stop the video and tell me what's been going on. Okay. So I will be back in a few instants. For you, I hope you'll use, I don't know, 5-10 minutes to look at the data and interpret it, and then make notes about what you think they're doing well, what they're doing poorly, and then you can compare it to what I will be explaining. See you in 5 to 10 minutes. So I'm back. I hope you've spent your 5 to 10 minutes, longer if necessary, examining the ratios using what you know about the dupont relationship, and that you have figured out the story. Now, let me show you how I would go about trying to interpret, trying to understand what's going on. So, first thing, I want to look at the profitability numbers first. So, here are the gross profit margin, operating profit margin, and net profit margin of the industry and of the company. In class before, I have mentioned that the gross profit margin is a measure of how successful is the company at controlling its cost of goods sold expense. And another way to interpret it is how much gross profit are we able to obtain out of our sales. Whereas the operating profit margin, 23 versus 19.918, that one tells us about the success of the company at controlling operating expenses and cost of goods sold. So cost of goods sold is still in there. So COGS and operating expense control is what we see here. And finally, net profit margin is the total story, the total profitability of the company, including all expenses. So, cost of goods sold, operating expenses, interest expense, and tax expense included. How successful has the company been at generating profits out of its sales? How I would go about interpreting this data is first, I would want to calculate the differences between GPM, OPM, and NPM because they have specific meaning. So, to do that, if you are using Excel or if you're doing this yourself, do this. Insert rows in between, up at the top and in between these profit margins, and then calculate differences. Start at the top by using 100% minus 55. So this is going to be 45% cost of goods sold percentage. And then the difference between GPM and OPM, so this difference, we're going to see that that's equal to 32 percentage points. And that will be your operating expense percentage for the industry. And finally, OPM and NPM, that difference here, 10 percentage points. If I were to see these in real life, I'd say, this is suspicious. Those are two round numbers. And you're right. This was an example that I came up with, that I invented. That's why the numbers, especially for the industry, are that round, that precise. But breaking it down in that way helps us see the different types of expense control of the industry, and doing the same thing for our company in 2024 will provide us with comparable data for our company. So, presto, here's what we have. So, cost of goods sold for the industry, 45%, 100 minus this, right? And for our company, it is 44.82%. Yes, it is slightly lower than the industry, which explains why the GPM for our company is slightly better than the industry. But honestly, this small of a difference is not very crucial, not very interesting. So if I was looking at this data, I would basically say that the performance of the industry and the company are quite similar with respect to cost of goods sold control. So, no big advantage or disadvantage in the cost of goods sold and gross profit. Next, operating expense percentage. Here, GPM to OPM, the difference was 32 percentage points. And for the company, it's 36 percentage points. 4 percentage point difference between industry and our company. Is this significant? Yes, I would say it is. So something under operating expenses is significantly higher for our company compared to the industry. So here I'm just making a note of it, but if I had the actual financial statements of the company, I would want to go in, dig into the data, and try to determine which of the operating expenses is creating this 4 percentage point difference. Okay. Um, what are my alternatives? Well, if we kind of review what's included under operating expenses, it is things like salaries and wages, advertising. It could be depreciation and amortization of the uh, non production fixed assets of the company. It could be research and development. It could be rent expense. It could be a whole array of different type of expenses that you include under operating expenses. Later on, I will talk about one of the potential explanations as to what might be going on, especially if we can use it to explain both this and some other interesting differences between our company and the industry. So, yes, note this. There is significantly higher operating expenses of the company, which leads to this big difference. Cost of goods sold was quite similar, but operating expense percentage being higher, significantly higher, means that we are now at a significant disadvantage relative to the industry numbers. So 19.18% is the our company's operating profit margin, whereas the industry has 23%, significantly better operating profit margin compared to us. Then the difference between OPM and NPM here is 10 percentage points. Here is about 9.25 percentage points. Is this expected? Well, think of it this way. Would you expect the interest expense to be lower for our company? Not really, because if you look back at the previous slide and your notes, you might see that the debt ratio of the industry was 50%, while for our company, it was about 65%. So there's a higher amount of debt being used in our company. So with higher debt, if we have a similar interest rate to the industry, then if anything, the interest expense should actually be higher. But looking at these, you might see that even if they had similar interest expenses, you would end up with an earning before tax, which is smaller for our company compared to the industry. And because taxes are usually a percentage of earnings before taxes, a smaller amount, smaller number of earning before tax would mean tax expense would be lower. And because I've constructed this question, yes, I know that actually interest expense was a little higher in our company, but because of the lower tax expense of the company, overall the difference becomes this. So here, again, not a huge difference and no very interesting story to look at. But totally what we can see is that the net profit margin of our company is just below 10%, while the NPM of the industry is about 3 percentage points, slightly more than 3 percentage points better than the better than our company. So for a net profit margin, the industry has the advantage. So how come it doesn't carry that advantage into the return on assets? So that's where we add in net profit margin, multiply that by the total asset turnover. So 13% multiplied by 1.04. This was in the original data given to us. So the sales of this company is 1.04 times its assets, whereas our company is performing much better and has a total asset turnover or sales 1.86 times its investment in total assets. So, despite a disadvantage in profitability, which comes mostly from operating expenses being high, thanks to this advantage, this difference outweighs the disadvantage coming from here, which leads to an ROA number for the industry of about 13.5, and for our company, 18.47. So the difference between these almost about 5 percentage point advantage in return on assets. And this advantage is caused by a big advantage in efficiency using assets to obtain sales, and despite a disadvantage in profitability. And again, the lower profitability is coming from high operating expenses. So these two combine into an advantage of our company in the 2024 return on assets. So, is that the end of the story? No, we want to also see how this ends up in return on equity. And for that, we calculate the equity multiplier, total assets over equity. For the industry, which uses 50% debt, 50% equity, 100 over 50 gives us an equity multiplier of 2. Whereas for our company, which had 65% debt, which means 35% coming from equity, 100 divided by 35 gives us an equity multiplier of close to 3. Well, just a little. If it had been 33% equity, it would have been exactly 3. But now we are at 2.86. So we are using significantly more financial leverage. So our equity multiplier is higher. The equity multiplier, unlike profits and unlike total asset turnover, is a little more complicated to interpret. So higher net profit margin, yes, that's good. We are more successful at controlling expenses. We're more successful at generating profits, you could say, though not in this case. Or a higher total asset turnover. If it's high, that means you are more efficient at generating sales out of your assets, okay? And the higher, the better. But when the equity multiplier is high, this has a big kind of magnifying or multiplying effect, but it comes with a cost. What is that cost? Well, the more debt you use, you are increasing the probability, the chance of going bankrupt. A company that uses 0% debt would not be able to go bankrupt until it loses all of its assets. But if you are using borrowed money, if you're using credit, then what you have there is if you are not able to make the interest plus principal payments on the money that you borrow, you can go bankrupt easily. So financial leverage is advantageous when things are going well, when you're generating good profit on the investments that you're making. However, if things go poorly, then that is also magnified with financial leverage. So it adds a significant amount of risk onto your structure. So, yes, it increases the ability of the company to go from a return on assets of 18.5 to almost 50, close to 53%, while the industry uses less financial leverage. So its ROA only becomes an ROE of about 27%. So this huge difference in return on equity is the result of high return on assets, but with significantly higher financial leverage, as seen in the equity multiplier. We are able to benefit from the successful usage of borrowed money by this company. So that is my interpretation of the data about this company. And even without using the full financial statements and all of the data included in it, just by using basically three ratios: net profit margin, total asset turnover, and the equity multiplier, I'm able to decompose the total performance of this company, this big success at return on equity, that is caused by uh, good efficiency, generating high sales out of total assets, despite having relatively low profitability in the net profit margin. And this net profit margin is similar in cost of goods sold and interest. However, it is low due to high operating expenses. And the third factor, the equity multiplier, because we're using significantly more debt in our capital structure, this multiplicative power causes the difference in ROA to increase to almost double the performance in ROE. Again, this comes with higher financial risk, but right now, performance wise, we are much better compared to the industry in our performance. Now, the explanation that I had promised. Could we come up with an explanation which together explains why our net profit margin is low? Remember, we had a high operating expense percentage. Could it explain this high operating expense percentage and the high total asset turnover at the same time? My potential explanation that I like here is that we are actually paying high salaries and or high commissions to our salespeople. We're using high quality salespeople, and we're paying them high amounts. And this may be leading to their big success at generating significantly more sales out of our investment in assets. So the high operating expense might be due to helping this company generate higher sales. And this, again, potentially could explain a few things together in this analysis. So that's my relatively quick financial statement analysis, in particular dupont analysis of this company's performance. I hope you found the analysis useful, and I hope now that we're at the end of this semester that you agree that by using the financial statements and being able to extract some of the information from those financial statements, that now you are ready to use it to understand and then explain to others about the financial performance of these companies. So I enjoyed having you in my class. I hope you have a great new year.